Charlie Evans just said, pretty well set with policy with inflation where it is. Is he right? Do you think policy is in a good place?
I think it's in a very good place, maybe surprisingly good. It wasn't so obvious when the Fed started pushing interest rates down that was the right thing to do. Now it's looking pretty good. We've got the interest rate around almost exactly where the inflation rate is, so a zero real federal funds rate, which is a push, which most of us think of as being slightly aggressive, not grotesquely aggressive, slightly aggressive. And that was the fear that some people had when the Fed started moving down. But, you know, the inflation rate has not budged, basically, as Evans said. And as long as it doesn't budge and the economy keeps trundling along at 2% or so growth, I think the Fed is just going to stand pat indefinitely, as long as that lasts.
He seems surprised by the fact that inflation hasn't budged. Said it ought to be rising. A lot of people agree with him. Sounds like you do as well. Why do you think it isn't?
I do. I wish I knew, you know. That's the $64 trillion question. That's the question that Jerome Powell and his colleagues go to bed every night pondering. Nobody really knows the answer. There are a few little straws in the wind about the composition of the unemployed, about whether workers are getting benefits that are not showing up in wages. For example, Charlie alluded to this very obliquely, but you see hiring standards falling, people that don't necessarily have the greatest work experience are getting hired anyway, whereas in a labor market that was weaker, they wouldn't be. So I think some of it is coming out that way. But don't get me wrong, I don't think we have a full explanation of this. I think it's a big mystery.
Alan, you know, you were at the Fed at this golden moment in the mid-'90s that we keep hearkening back to, when there was this, I guess, recognition over time that, in fact, unemployment could go lower than we previously thought without producing inflation. There were 3 rate cuts in '95. You know the whole history, of course. But does it feel like there's a rerun of that episode happening?
Yes, sort of, but much more extreme. I mean, back in the day, I got criticized in '94 when I was vice chairman of the Fed for suggesting we could push the unemployment rate below 6. I didn't say a number like 5 or 4. People would have thought I was crazy then. And frankly, in '94, I didn't believe we could go that low safely. It turned out that we could. This episode is even more extreme. We've got the unemployment rate down below 4 for quite a long time. And the Fed, as Charlie Evans just pointed out, is still trying to push inflation up, not hold it back. So, yes, similar, but even more so these days.
Alan, you know, they spoke about the fact that manufacturing remains weak. So much expectation continues to be put on the back of the consumer. Is there a point where we need to start worrying about the manufacturing prolonged weakness?
I think the answer is yes, but mostly regionally. As Steve pointed out in his interview with Charlie Evans, there are regions of the country where manufacturing is a bigger deal than in some other regions. So you want to think of this as mostly sectoral. Manufacturing, you could say, excuse me, manufacturing, you could say, is in a recession. So if you're in a region of the country which is heavily into manufacturing, or certainly, especially the sorts of manufacturing that are impinged upon by this trade mess, you're in a recession, actually, even though the rest of the economy is in a boom. The answer is manufacturing is a relatively small share of employment. It's down below 10%. So one way to phrase your question is, could the rest of the 90% still do well, even when the 10% is not doing so well? I think the answer to that is yes, if you look at the whole country.
I'm curious, since we rely so heavily on the American consumer as a driver of this economy, will this strike in Iraq last night against Iran do anything to the American consumer? I'm looking at gas futures right now, up more than 3%. At one point this morning, they were up 4.5%. If gas prices rise, won't that take away some of the spending power the American consumer has?
I think so. I think that's the biggest question right now by far because of the developments in the Middle East last night. We don't know where that's going, how big it's going to be as a geopolitical event. It may turn out to be quite big, or maybe it won't. And therefore, we, of course, don't know what it'll be as an economic event. But the direction that you're talking about is exactly right. If we imagine this blows up into a very big, quote, oil shock, and people see pump prices of gasoline and home heating oil prices and things like that skyrocketing, that will put a dent, first of all, into the pocketbook, exactly as you said, for buying other things, but also into confidence. That's the kind of thing that can shake people up. And it's, as Charlie Evans, I think, said in the interview, it's just way too early to make any judgments about that. But it's not too early to say this has now jumped to the top of the worry list. Trade frictions have been at the top of the worry list for a long time. This has now leapfrogged it.